Did you know that Walmart Inc., WMT, out of the 30 companies that make up the Dow Jones Industrial Average, while numerous other companies went bankrupt and people lost everything they had, Walmart was the only one to earn a profit between the start of the 2008 bear market and its conclusion during the global financial crisis of 2007 to 2009. Today, with inflation touching the sky and recession predicted by economists, you are confused and maybe scared of what the future will bring us. You may be wondering if there is a way to save your hard-earned money somehow, or even increase it, perhaps also benefit from the impending recession. Hello 101 community! Welcome back to our YouTube channel. In this video, we will introduce 7 stocks with which you can safely get through the current and future recessions. But before we begin, if you are new here, make sure to subscribe to our channel and turn on notifications to never miss any updates. Due to the impact of the COVID-19 pandemic and the political measures on various economic sectors, the past few years have been difficult. More importantly, it brought about some long-lasting modifications to how people live. Investors are searching for recession-proof stocks to buy in order to generate strong returns as investment themes have changed. However, since then, other challenges have emerged. There is justification for numerous rate increases because of the high pace of inflation. The effects of several rate increases on the economy are still uncertain. So let's start right away with the 7 best stocks to buy now. Number 1. Pfizer, PFE. PFE stock, which has a beta of 0.68, is one of the finest stocks to purchase during a recession. The stock also offers an attractive 3.5% dividend yield. Pfizer reported strong sales growth of 92% for 2021. However, growth was just 6% when COVID-19 vaccine sales were taken out of the equation. The corporation has provided guidance for revenue of $100 billion even for the current year. This would indicate year-over-year, YOY, sales growth of 23%. The crucial issue is that the COVID-19 vaccine-driven expansion improved Pfizer's cash position. This makes it possible to make bold investments in R&D. Pfizer anticipates spending at least $10.5 billion on R&D this year. Additionally, Pfizer has a substantial medication pipeline with numerous treatments. 10 products are now undergoing registration, while another 27 are through Phase 3 studies. The pipeline should guarantee sustained, robust revenue growth. Pfizer has sought acquisitions for the past 2 quarters. The company is considering the inorganic path to significantly boost the product pipeline now that it has increased financial flexibility. PFE stock appears to be appealing overall at a forward price-to-earnings (PE) ratio of 7.5x. The stock is probably going to perform well in a recession. Number 2. Walmart, WMT. The American economy is founded on consumer spending, and retail sales are a significant portion of this spending. In the event of a recession, governments prioritize increasing retail sales. Retail stocks are hence comparatively resilient to economic shocks. One of the best retail-related stocks to buy is WMT stock. The company is intriguing in addition to the macro component because of its low beta and 1.7% dividend yield. It's important to note that U.S. comparable store sales have climbed by 15% over the past 2 years. Sales were increased through omni-channel sales capabilities, and services like same-day delivery further aided growth. Another upside is that supermarket sales are starting to pick up. Despite low worldwide sales, Walmart is present in fast-growing markets like India. International sales will likely support the general growth trend over the next few years. Walmart reported $11.1 billion in free cash flow for the 2022 fiscal year. This offers the business plenty of flexibility to keep paying dividends and buying back shares. Overall, it is doubtful that WMT stock will generate significant capital gains. Dividends are essential to the portfolio's strategy to reduce risk and increase cash flow. Number 3. Lockheed Martin, LMT. Another low-beta name worth keeping in the portfolio during uncertain times is LMT shares. As geopolitical tensions increase, I would keep it in my main investment portfolio. JP Morgan recently predicted that the LMT stock would do better than average amid the Russia-Ukraine situation. A strong 2.9% dividend yield rewards investors even when the stock moves sideways. It's also important to note that even through the pandemic, global defense spending rose. As a result, the industry is somewhat resistant to other macro influences. There are 2 reasons to enjoy the stock specifically related to Lockheed Martin. First, Lockheed has a $135 billion backlog of orders at the end of 2021. This provides revenue and cash flow visibility over the following 2 years, even in the event of a recession. Furthermore, the company's order backlog will probably grow as international tensions rise. Lockheed has been concentrating on increasing international sales, and the Ukraine conflict may result in orders for the corporation. In the past 6 months, LMT stock has returned 15% overall. A projected PE of 14.5x suggests that there is space for growth as money is invested in defensive stocks. If you liked the video so far, press the like button and subscribe to the channel. Also, if you want to develop yourself financially and want to take your future into your own hands, check the links in the video description. You can support the channel by visiting our merch shop and buying one of our products. The link is in the description. Let's continue with the remaining 4 stocks. Number 4. Altria, MO. From a valuation standpoint, MO stock is a desirable stock to purchase. It is worth considering in the event of a recession due to its low volatility. The forward PE for MO stock is 10.7. Additionally, the stock has a sustainable dividend yield of 7.3%. Altria did not violate antitrust laws when it invested in Juul, according to a recent ruling by an administrative law judge. The announcement has resulted in some favorable price movements for the stock. It's also important to note that MO stock has fallen as investors pay attention to the company transition. Altria's cash cow, though, continues to be its core business. First, its cash flow will guarantee that dividends continue. Altria also has a lot of financial room for investment in the non-combustible market. Additionally, Altria owns 45% of Cronos, Nasdaq Krone. Regulatory hurdles have harmed the cannabis sector. However, there is a chance of value creation from the stake if marijuana is legalized at the federal level in the United States. Number 5. Apple, AAPL. The price of AAPL stock has been rising, with gains of 31.8% over the past 12 months. Despite the 0.5% dividend yield, annual dividend growth will probably stay steady. With a projected PE of 28x and this potential, AAPL stock is also not overpriced. I think the iPhone will continue to be the cash flow generator in growth accelerators. The iPhone category growth is projected to continue to be strong, with the faster adoption of 5G. Apple is simultaneously attempting to diversify. As an illustration, the business's services segment growth has continued to be solid. The segment's revenue for Q1 2022 was $19.5 billion. The category revenue growth was 24.2% year over year. The wearable, home, and accessories segment's revenue increased by 14% to $14.7 billion in the first quarter of 2022. The crucial idea is that various segments would likely fuel growth in the coming years. This will guarantee that cash flows keep increasing. The business recorded an operating cash flow of $47 billion for Q1 2022. This suggests a $188 billion annualized cash flow potential. Regarding the cash reserve and cash flows, the business is positioned to raise dividends and buy back shares. Number 6. Newmont Corporation, NEM. The dividend yield on NEM stock is 3.3%, and the firm has a beta of 0.29. Gold has trended higher as a result of inflation and rising geopolitical concerns. The price of NEM stock has increased by 19.2% during the past 6 months. As money moves into defensive equities, the rise will likely continue. Newmont reported $12.2 billion in revenue and $5.9 billion in adjusted EBITDA for 2021. The business generated $2.6 billion in free cash flow during the same time period. With gold increasing, Newmont is set up for increased EBITDA margin and cash flow. This will result in rising dividends. In the upcoming years, Newmont anticipates lowering its all-in sustaining cost. The company is set up for margin expansion even if gold prices remain sideways. In terms of assets, Newmont has plenty of reserves to guarantee steady output until 2040. NEM stock appears to be a long-term value builder as a result. The corporation is free to explore future asset growth with a $5 billion cash reserve and an $8 billion total liquidity reserve. A balance sheet with investment-grade credit increases the advantages. Number 7. Chevron Corporation, CVX. A recession generally has a negative impact on oil prices. However, it makes sense to take into account an oil and gas company for a defensive portfolio, given the global unrest and inflation. For several reasons, CVX stock would be my choice. The company has a net debt ratio of 15.6% and has a first-rate balance sheet. A balance sheet with investment-grade credit gives you the freedom to fund exploration projects while maintaining dividends. Chevron also has assets with low break-even points. Brent declined in 2020 as a result of the epidemic. The business showed positive operating cash flows even during that year. Regarding investments, Chevron has had a reserve replacement ratio of 103% during the past 5 years. The company has increased reserves through investments in high-quality existing assets despite having a healthy production profile. It's crucial to note that Chevron generated an operating cash flow, OCF, of $29.2 billion in 2021. OCF will probably be greater in 2022, given the trend in oil prices. Additionally, potential cash inflows will assist Chevron in reaching its $3 billion annual share repurchase goal. Every crisis also harbors an opportunity. This might even be the chance of your life. Always keep in mind, Warren Buffett once said that it is wise for investors to be fearful when others are greedy and greedy when others are fearful. That's all for today's video. I hope you enjoyed it. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you will be notified of every update. Also, don't forget to check the links in the video description. And while you are here, I'm sure you want to continue on the path of financial education. Click to watch the video appearing on your screen right now. I will see you there. Take care and stay tuned.